Hi, welcome to INR Bond Search for Yields, issue number 77. I am Nikhil, and in today's topic is how the passive fixed income investors are losing their investments or savings to the inflation. In the previous edition of Search for Yields, we spoke about what are the compounded losses for the inflation and how the cumulative losses are resulting into a huge pile of underperformance for their passive investments. Today, first we'll start with the latest CPI prints for the domestic and the global countries. And in the last week, we have seen the CPI came in at 6.95%, which is higher than the previous reading of 6%. And the core inflation is reported at 6.53%. And the latest RBI policy meeting also, the policymakers stated that they're expecting a higher inflation, and they also raised their growth expectations, growth outlook of the inflation. And in the global markets, the US reported CPI at 8.5%, which is the highest in the last 4 decades. And also the same scenario with the UK and the Eurozone as well. So coming to the food price index, the FAO index has touched the record highs in the month of March, which is almost 13% up on monthly basis. It's mainly due to the Russia-Ukraine issues which is going on, which caused the wheat prices to surge. And coming to the whole the asset class performance, how the fixed income instruments have done against the inflation. This table shows on the top gainers, the INVITs have outperformed the inflation growth. The INVITs usually pay the investors the dividends in the for all the unit holders, and the dividends are as per the regulatory, they're mandatory to pay at least 2 quarters of dividends in the whole financial year. Also, any rally in the share price of the underlying asset will also give for a capital appreciation. So, accounting for the both the rally in the underlying prices and as well as the dividend, the Power Grid InvIT has given the unit holders almost 35% of returns in the last 1 year, which is outperforming the inflation as much as by 30%, which is the largest spread compared to the other instruments. And the second top performer is the A-rated corporate bonds. A-rated corporate bonds with the 1 or 2 year maturity are generally giving around 9%, and the outperformance is more or less under 3-5%. And AA corporate bonds and AAA corporate bonds also have done the same, but AAA corporate bonds have marginally outperformed the average 6% inflation growth. But if you take the latest numbers, which is 6.95%, AAA corporate bonds would underperform. And coming to the Bharat Bond ETF, Bharat Bond ETF at the current level they're offering the 10-year is offering around 7.3, and the 8-year is offering around 7.2%, which is higher than the current inflation. So, however, if the inflation keeps on rising and the yields tend to rise, the investor would see kind of a drawdown in the portfolio due to the sharp rise in yields. And this goes the same with the government bond, government securities, and the SDLs as well. The GSEC in the latest auction, the cutoff was at 7.24%, which is almost 30 bips rally from the pre-RBA policy. And as well as the SDLs, the cutoff was at 7.2%. So current yields are definitely offering investors a room to beat the inflation, but holding them and carry forwarding their positions in these assets could lead to underperformance if the yields rise from current levels. And in the top losers side, we have the higher underperformance. Highest is from the liquid funds which are under 6 months, and they're giving on an average of 3%, and as well as the saving deposits, fixed deposits also are giving the quite less returns than the inflation. And the ultra short term and short term are a little better off, but as the spread is lower compared to the other instruments. And I'm gonna just repeat the previous editions of what would be your compounded losses if you keep on underperforming every year. We have assumed the inflation on an average of 6% and FD rates at 4%, and mutual fund, short-term mutual funds at 5%. And we have taken 3-year time frame, and we have taken we also took 100 rupees invested in all these instruments. What would be at the end of 3 years? At the end of 3 years, all the losses accumulated and compounded, the investor would see if almost 6% underperformance to inflation if he invested in the FD rates, and as well as a 3% underperformance in compared to the mutual fund returns. So this number keeps on doubling from every year if you see, because of the losses getting accumulated for every year, and also underperformance for the current year. And what is the right now? What is the amount? What really takes for the investors to beat in order to make up for the previous year losses, and also try to beat the inflation current year? For the from the year 2, investor needs to almost have to make up around 8% if he invested in the year 1 in FDs, and almost 7% if he invested in mutual funds. And this number also keeps on jumping for every year. If you see, it's in the year 3 it is almost 10%, and for the mutual fund investors is 8.3%. In India, the investors are better off, as it is still doable for the investors to achieve such kind of returns. But if you take a look at the US and Eurozone, where the bank rates is at 2.5% and inflation is at 6.5%, the spread is almost 6%. But it's not the same case in India. For them, the losses and as well as the expected rate of return is much higher every year passing by. And the best solution for all the viewers who are watching this video is do hop in on our QuickInvest platform. Check out our QuickInvest platform. You can use our parameters like given here, the returns return bar. Okay, set your return bar post tax, how much the returns are required for you in order to beat inflation, and you can narrow down our customized bonds list, and also look at our research note in order to know about that issue, and also experience our seamless transaction process. We also have a QuickInvest app both available on iOS and Player and Android. You can download them and have a smooth process of investing into the bonds. Thank you for listening in. If you find our YouTube videos useful, do give us a like, and also do not forget to subscribe to our channel. Thank you.